Good morning, everyone. My name is Connie and I'm the Director of NZ International Tax and Property Advisors. Welcome to a Boom or Bust webinar today. We have lots of exciting materials to go through, so stay tuned till the end. Feel free to post your queries during the webinar and we'll endeavour to answer all queries at the end of the webinar. So first up, I'll cover off some tax tips and relief during COVID. Then we'll have Robert from the insurance group and Gerard from Bizinsure, who will cover some insurance policy and tips for protecting your property portfolio. Next, we'll have Blandon from Mortgage HQ, who will show us how to maximize use of the historic low interest rate and the temporary removal of the investor loan to value ratio restrictions. Lastly, we'll have Alistair from Haig who will share his thoughts on how to invest in property safely during COVID. So this webinar will be recorded and will be released in due course. We'll also distribute some handouts after the webinar, so watch the space. So before we start, I'd like to tell you a little bit about myself. So I'm a chartered accountant, property consultant, and ex-tax lecturer. I have more than 10 years of tax, accounting, property experience from working in Big Four, mid-tier and small boutique chartered accountant firms, and with residential and commercial property investors with portfolio size ranging from 1 million to 10 million. Our firm is a one-stop chartered accountant firm offering tax, accounting, property, and training services for property developers, property investors, SMEs, and migrants. We specialize in taxation on land transaction, cross-border taxation for migrants, ID dispute, and small medium business tax, and tax consulting for landlords and tenants. Now that you know a little bit about myself, I'd like to know a little bit about the audience. So how many of you are property investors or developers? You can put in the chat box and can engage with you a little bit. That's B as in the property developer or property, yeah. So we've got some property investors here. Cool. So that's definitely why you guys are here, because you love properties, and so does we. So in terms of, I know the majority of the audience is from Auckland. Is there anyone outside Auckland here? Christchurch. Okay, so we do have a reach to South Island there too. Great. So carry on, and yeah. So for today, we'll start off with the depreciation restored for commercial and industrial building. And there's been some change of rules regarding the deductibility of feasibility expenditure. There's also some tax relief that's covering the increasing in threshold for low value asset and provisional tax. And there's been remission of use of money interest and penalties due to the effect from COVID. And lastly, I'll cover off loss carryback scheme. The majority of these are part of the tax relief package, aside from the deductibility of feasibility expenditure. This is a recent change in tax rule, which I think would be quite useful for the property audience, especially property developer who does feasibility studies on land use for the development. Too quick. So starting off with depreciation for commercial and industrial building, it's been brought back and reintroduced from the 1st of April 2020. So almost 10 years ago, the depreciation rate on commercial building was reduced to 0%, and now this has been brought back, and the aim is to decrease the tax liability and assist with the cash flow for businesses. So the depreciation rate is 2% for diminishing value and 1.5% for the straight line. It applies to non-residential building, and because depreciation is calculated on the cost of the building, and the cost consists of the purchase price and any capital improvements up to 1st of April 2020. So we suggest that landlords should ensure any capital improvements are captured in the cost base to maximize the depreciation deductions. So whether that is seismic strengthening work or improvements on the commercial buildings that you've made in the last few years. So as a case study, we were just going through this, we've got this company, AKL Limited, purchased an office building for 3.75 million on 1st of April 2019. The company spent around 0.25 mil for seismic strengthening work on the 1st of December 2019. And the company uses diminishing value method for all its assets. So how much can the company claim for depreciation deduction for the year ending 31st of March 2021? So have a think about for maybe 15, 20 seconds, and then put your answer in the chat box, and then we'll go through the answer shortly. Yep, so 4 million times the, yeah, so not quite 4 million, but yeah. All right, well, yep. Thanks for all your answers. So because we've got the depreciation for commercial and industrial buildings now, we can apply a 2% depreciation rate on the purchase price plus the seismic strengthening work, which is the total of 4 million. So we go 4 million multiplied by 2%, that gives us 80,000 of the depreciation deduction. So the tax effect on this is 22,400. So the company have 22,400 less tax to pay in this scenario. Moving on to feasibility expenditure. So there's been a change in rules to remedy the black hole feasibility expenditure. So prior to the rule changes, feasibility expenditure can be a black hole expenditure. So what I mean is that it cannot be immediately deductible because it is part of, it relates to a capital expenditure, and nor can it be depreciated over time because an asset yet to be formed. So eventually that discourages business seeking to invest in new projects or assets due to the unfavorable tax outcome. So there's been a recent change in tax law to remedy this issue. What this new rule kind of says is that if you incur feasibility expenditure of less than 10,000, then you can immediately deduct it in the year it's incurred. If it's more than 10,000, then it needs to be spread in equal proportion over 5 years. So as an example, say we've got like company A, who's a commercial property developer, and is trying to explore the feasibility of building on a mix of retail or industrial units, and they incur planner cost and say feasibility study of 50,000, and then the project didn't go ahead. So under the new rules, company A can spread the 50,000 of the feasibility study cost over 5 years. And if the cost was not 50,000, it was only 5,000, then it can be immediately deductible under the new rules. So this new rule overrides capital limitation, and it applies from the 1st of April 2020. It doesn't apply to depreciable asset with a 0% depreciation rate, so that includes residential properties. So moving on to the increase in low value asset threshold, the aim of this tax relief is to decrease the tax liability and help with the cash flow, and also encourage businesses to continue investment in the short term. So the increase in the threshold is from 500 to 5,000. Note that this is only a temporary relief. So it's for asset purchase from 17th of March 2020 to 17th of March 2021. And then that 5,000 threshold is reduced to 1,000 for purchases after 17th of March 2020. So this is definitely a great change. Changing from 500 to 1,000, because in the past 500 seems to be quite low, and a lot of the asset needs to be capitalized, and which delays the timing of the deduction. So we suggest that big asset purchase to be made before 17th of March 2020, where cash flow allows. Whether this could be heat pumps or insulation costs under the healthy home standard as required. So and similarly, with increase in thresholds, there's also the increase in threshold for provisional tax from 2,500 to 5,000 from 1st of April 2020. So again, this aims to help small business with the cash flow, so they don't need to pay provisional tax that is under the 5,000 threshold. Some business may consider tax pooling, where there's limited cash flow to make the provisional tax payment. So for those who are not familiar with tax pooling, it is a tax intermediary where the taxpayer can pay into the tax pool to fetch a lower use of money interest rate. So currently, the IRD's use of money interest rate is 7%. If paid, but if paid into the tax pool, then the use of money interest could be around 45%. So the use of money interest saving is the difference in the interest rate. And some tax pooling company are Tax Management New Zealand and Tax Trader. If the business can afford to pay provisional tax because of cash flow reasons, IRD may consider remission of use of money interest and penalty. There are 3 criteria to meet. So first one is that tax is due or on or after 14th of February 2020. Secondly, the taxpayer's ability to pay the tax by the due date has been significantly affected by COVID. And lastly is that the taxpayer contacted IRD for temporary, to request for relief and pay the outstanding tax as soon as practical. And this remission of use of money interest applies for 2 years from 25th of March 2020. And so, you might ask, as a taxpayer, what should you do given the tax relief? Firstly, review your cash flow position of the business. If your cash flow is in a bad position, like say if the business can't meet the wages or overhead expenses, then you may want to consider just don't pay the tax, just deal with the matter and pay the tax when the matter stabilizes, and then apply for a remission of use of money interest or late payment penalty on application with the IRD after the matter is stabilized. And very likely that the IRD will approve and accept the request. If your cash flow is slightly better, where you can meet your outgoings for the next 2 to 3 months, you may wish to consider tax pooling. In case IRD declines your request to remit use of money interest and penalties, at least you will pay a lower use of money interest rate. Otherwise, just pay the tax due if cash flow allows. Lastly, I'd like to just cover off loss carryback scheme. So this aims to provide fast cash flow relief for businesses, and it applies from 15th of April 2020. Business can estimate their losses for either the 2020 year or the 2021 year and use it to offset profit in the past year. So as a result, they can claim a refund for loss carryback by re-estimating provisional tax or amending income tax return. So simply, you can view it as putting together the profit-making year and the loss-making year to determine the quantum of the tax refund. The taxpayers can re-estimate their 2020 provisional tax anytime, even after the provisional tax installments, the third installment, and which is generally 7th of May 2020 or 7th of May 2021. Taxpayers can elect to carry back losses and then reduce the current last year's provisional tax and refund profit year's provisional tax or income tax. And lastly, that the ring fencing of tax losses cannot be carried back. So this takes me to the end of my presentation. As mentioned, feel free to post your queries in the chat box, and then I will respond at the end of the webinar. If you prefer to contact me or to further discuss, feel free to contact me through my mobile or as email as per the screen. I'll now hand you over to Robert and Gerard, who cover some insurance policies and tips for protecting your property portfolio. Over to you, Robert and Gerard.